Welcome to Ahead of the Curve. Subscribe now.
Welcome to Ahead of the Curve 1776. It is I, Mr. Curve. I hope you guys are having a swell Fed day today. Today was Fed day, the interest rate release of the U.S. Central Bank. It was an eventful day. A lot happened. A lot of things were said. A lot of Q&As took place as well too. Read the statement, which we'll go over later. It was definitely basically an inconsistent, ambiguous day. We kind of had an interest rate hike, although, you know, anytime it's 0.25% is always a dovish, regardless whatever the monetary statement afterwards is, and also the press conference. But it was definitely a lot, and we'll get into it, guys. If you're new to the channel, we talk about everything from economic data, monetary policy, politics, market, and trading strategies. So let's get to the data, and let's get to the money. Here's my videos down here, guys. Make sure you like, comment, share on each one of those, guys. Please watch the ads. That's how we fund the page there. Also, my Patreon, I will be doing this more in depth. I'll have a $5 membership, which I'll go over certain key points of trades that I partake in, as well as a $25 where I'll probably do a live Q&A probably one day a month, just to give that extra benefit, and we'll go over stocks or over bonds, whatever, anything somebody's into. We will talk about it as a group. Also use my affiliate links to get yourselves involved in the game. So let's get to it. So we'll just do a slight recap of basically what transpired. We did have some job owning going on from the Fed, as well as the UBS situation buying Credit Suisse there. We also had ECB Lagarde spoke, basically harping on that the liquidity requirements of their banks are very confident in their excess requirements for their banking capital, so they just want to make sure that there's no spooky things going on over there or contagion pop-ups over there. We also had the Bank of Japan have their bank holiday on Monday. We scroll down here, we had Canada's CPI, as well as their trim and median CPI. Definitely came in a little bit softer, but the median is definitely picking up there. If we're looking at an overall reading of this, about 5% overall, which is still exceedingly high. They all like to try to get to that 2% target. We also yesterday had President ECB Lagarde also spoke as well too. I did watch that. That was actually posted on the website. It was very short. She just basically reiterated the stuff that was on Monday. And then, as you guys can come down here, the UK's year-over-year CPI is 10.4. Now, I gotta say, compared to the US, at our 6% reading, a 10.4 is more realistic. Is probably what the G7s as a whole, or aggregate, or median, is probably where it's at as far as the interest rate is concerned. We'll scroll down here. We also had ECB speaking again, spoke again. Look at this: must, will, and bring down inflation to target. So they are all synonymous and unanimous in bringing this inflation back down to 2%. One thing that was very crystal clear with the interest rate decision today from the Fed was they are going to get to that 2%. Now, I will tell you, is this going to be a 2000s situation? Is this going to be a 1987 situation, or a 1929? I mean, how far will we go out on that edge before we get to that 2%? Will we have banks just totally fail? Because the one concept a lot of people don't realize is if a bank fails, essentially it can't lend. And then consumers, whoever's getting that capital, can't spend, whether that's in capital investment, any type of spending, right? So it's just not being put into the economy, and it's not being used. It's not being used out there in the world, which means that is deflationary. So they are definitely, I believe, now that I've seen this for a little bit and was able to clearly, think about the situation, they are trying to get that inflation back down to 2% at any cost. They are definitely playing chicken. They are definitely staying strong. Do I think they're going to do the stealth QE, just like the thumbnail says? Absolutely. They're going to be dropping cash, here and there to different entities. But overall, they want these markets to, pull back a little bit. They want the housing sector to pull back. They want the banking to pull back. They want overall all of these things to pull back, guys. So it is going to be pivotal that you get that straight going forward, so that way you can assess that with any asset or instrument that you're involved in, because that is going to be the case. Now, will trading just collapse? Absolutely not. Will investment just, absolutely collapse? No. But we'll start to look a little bit closer at more businesses that deserve the capital, as opposed to just, a meme or something like that. Scroll down here, guys. We had the German auction as well too. We also had today Fed Day. We'll go over that. Went up that quarter point there. Basically they went up the 25 basis points. From what I've seen, based upon their dot plots, they're probably going to go up maybe another 25. But again, guys, just like I told you, empirically, that terminal rate is 5.25. So we're at that, 4.75 to 5. If they go up a little bit, it'll go from 5 to 2.5, 5.2. 5, but I don't think they're going to go any higher than that, guys. And that is actually that is expressed due to the statement as well as the Q&A. I have to say, Powell is a little bit standoffish this time. I think he's kind of at the end of his rope with all of this, being told from basically the White House and Congress, as well as the pundits and everybody like that. I think he's kind of fatigued with the entire situation. He probably has worked relentlessly over the last couple of weeks due to all the bank situations, with numerous meetings between Yellen, who was the former federal head of the Reserve. So they just basically are putting their two brains together to try to keep this thing from collapsing. But as you can see here, set the target from 4.75 to 5. 5 is huge. I mean, that basically means a mortgage is going to be 8-9%. That means that a 720 to 850 credit score for a car, maybe it'll be like newer car, maybe like 6 or 7, maybe 5. But again, guys, overall this is going to be expensive money, which means that it is going to act as a counter inflation. It's going to be disinflation. We're going to be moving away and getting closer towards maybe that 2% mark. Now we're at 6. We got a long way to go. I see it going down two ways. Either it's just going to fall off a cliff, and then we're basically going to just have negative readings over the next year or so, which is possible to get it back to that 2% before they turn on the full spigots, or they slowly get that downward slope, which again, guys, there's a lot of capital out there despite everybody's idea and notion of what's going on. There is a ton of capital still out there, and there's still a ton of money as well too. There's a lot of money drying up and things are costing more, so it's taking more dollars to get there, but it is still out there. Also, we're going to have the Swiss interest rate decision. They're expected to go up 50 basis points there, 0.5%. Also, we're expecting a 25 basis point hike from basically the UK bank there. I'm going to say that they're probably going to be dovish as well, so I do expect further strengthening of the US dollar for tomorrow. Stocks, definitely slid off the cliff due to everything that was said. Now, one thing I will say, why are we so focused on this unemployment claims being more focused on as a red high alert? I guess they're waiting to see the tide turn, because I'm going to tell you guys, I've been out there in the world and I've been in several stores, and it's very slow. It's very slow compared to what we normally do, especially as being a almost 70% consumer driven economy. I did not see a lot of consuming happening. We're probably going to see new sales for tomorrow. We'll go over this as well too, probably on Friday, but we're seeing new sales, as you guys can see here. Those will probably be up, because existing home sales today definitely shot up there a little bit. I'm sorry, that was on Tuesday, so existing home sales were higher there. So we kind of had a little bit of an effect yesterday with Yellen, that stronger reading, as well as Yellen talking. We did have the dollar kind of go back and forth, because they're definitely really trying to talk up the system here. So we'll scroll down here. We'll have those PMIs to finish the week here, but a key note on those interest rate decisions, as well as more importantly those statements. I mean, anytime you get to 4.25, it's going to be viewed dovish, regardless of how it actually shapes out with the statement. And that's pretty much it for economic data, guys, for the week. We'll also have daylight savings times to put us all back on the same time frame as far as our trading servers. So therefore, we should definitely see a little bit more influx of liquidity, as well as less volatility. So let's get you guys now over to the most liquid pair, the Euro/US dollar. So it's always a buy the rumor, sell the fact type of situation. So we definitely had, talks of this morning's trading between the Euro and the US trading session pushing up there, that US dollar getting weaker there. So we see a uptick there, or an uptrend where that's the US dollar getting weaker. We see a downward trend, the US dollar is getting stronger. And then obviously we had the interest rate decision. Once people digested that, and then the statement was being read, a lot of people took that as a dovish meaning. I don't think there was any way out the door that they were going to get a more hawkish outcome. So basically we just shot up there basically a full cent. So we're going to say 1.08 cent up to the 109.7 there, 12 at the high end, and then we definitely pull back there after that Q&A developed, and it started to become clear that they're going to at all costs get to that 2%. Now again, just like the thumbnail, are they going to be doing stealth QE? Absolutely. They're going to be coming in, they're going to be going real close, they're going to be dropping it off to certain entities that they think or deem worthy of making sure that the banking system doesn't collapse. But as far as those lower banks, honestly, guys, I did read a study that says about 50 to 60% of our economic drive is the smaller banks as far as, what they lend out to the actual communities. So, again, guys, I don't know if they really care about that or they just care about the actual headline number of what it's supposed to look like. So we'll have to see how that develops, and I'll be right along for the ride with you guys. But where I see this probably going for the week, I do see probably some strengthening. I think we're probably going to, unless we have some very dovish readings from the Swiss as well as the the Brits. I definitely think we're going to pull back a little bit for the U.S. dollar. I'm sorry, pull back for Euro/US dollar and the cable U.S. dollar. I definitely think we're going to pull back a little bit here. Probably a sell-off just due to the fact that we did get that 25 basis point hike. A lot of people weren't even considering that. A lot of people were saying we're going to go zero, maybe possibly a cut. So overall, the lasting effect will still be hawkish overall. But again, it starts to become clear that they'll just accept the collapse at this point, just to kind of have an OA moment. So we did get a very deflationary, because we got a deflationary effect out of that. Maybe that's what they hope for. Again, maybe another bank to collapse. Maybe they stealthily inject it with some cash. But overall, I think they will save a few of the bigger ones just to have everything else pull back substantially. So let's go ahead and take a look. I won't bore you guys with the economic projections or any of that stuff, because that really, for this page is geared more towards traders and investors. So, all of that is good and well, but we'll have to see how things actually develop. All of that stuff is just pretty words on paper, but we'll have to see how it develops because our money is being tied up in it. Let's go over to the most liquid commodity pair, gold and US dollar. Again, they are all synonymously saying, all the head figures are synonymously saying that they will backstop a lot of these institutions. So just be mindful of that. Now, gold definitely had its nice little run up. I actually capitalized on this guy earlier today. Had a nice little run up in the morning there once we had that overlap between 8 and 12 between the Euro and the US session there. Definitely ran up a little bit about that psychological low of 1950, and then it definitely did pull back a little bit there. And then obviously after we read that statement, it did shoot up, got up to about the 1978, and then it pulled back a little bit there due to those Q&As. Then the digestion, but overall I do see this guy probably still going up just due to the demand of precious metals, as well as the stealth QE. A lot of people are smart like me. They're probably thinking that in the back of their minds, you might want to have something in just in case they turn on the spigots and then they turn around and inflate it. So I'm actually very bullish on gold as well as silver. I think the next psychological step from here, it'd probably be 2000. Now, will it have a pullback due to the interest rate decisions from the Swiss and the Brits? Possibly. And that's one thing that we're going to be mindful of. You can't expect anything to just go straight up. There is ups and downs. There's sideways consolidations. There's upward pattern movement, downward pattern movement. So we'll have to be vigilant of that. But again, guys, probably overall, probably a long-term 1 hour chart, 4 hour chart, we're probably seeing a nice uptick. And again, we'll get more into that probably on my Patreon, because I think that'll be pivotal to kind of, separate you guys out a little bit and see who wants to dive a little bit deeper into what's going on. And then obviously, you guys know the name of the game. You got to pay to play. Let's get you guys now over to WTI and US dollar. Now, WTI is obviously a commodity here, but I definitely think it's pulling back quite a bit, even though it had a nice little run up here. We'll go out on a 1 hour chart here, but we'll go out on a 4 hour as well too. It definitely pulled back quite a bit after that 80 mark, but I do still see this as a downward slope just due to the demand factor. With the rates being as high as they are, who's going to want to be paying for this stuff, guys? We ran up a little bit here from where we're at. I'm actually looking at a 4 hour chart here on my other computer. So basically we did pull back quite a bit. We had a high about that 80, but I still see a downward slope here, guys, just due to the fact of demand falling off, as well as that higher dollar cost. It's just going to, and plus, if people aren't buying stuff, you don't have to, fill up these trucks to get the, the merchandise or products to where they need to be. So overall, a slowdown will occur, and that always is translated in a positive correlation to WTI. So we'll check that out as we go along. I don't see it going past the $75 mark. I definitely think we're probably heading more towards the $60 mark as the next stop, which is good overall, because if we go back to the markets here, we can actually see that gasoline is pulling back as well too. We're still at a 2.77 overall, but I definitely think we're going to be taking a little bit of a nosedive on that as well too. We had a high in 294. Let's go out on a daily chart. And we're at the 3 mark there. We're at the 350 back in November last year. So we almost shut off almost a full at the low here, a full dollar off. And I definitely think there's more to go just due to the stance of the Federal Reserve. Now, can they change their minds overnight? Absolutely. They could just change their minds and say, hey, you know what? We made a vast mistake. We made a pivotal mistake. We're just cutting rates where, we're going back to MMT, right? We're just going to inflate away everything. So is that possible? Absolutely. And we'll just be mindful of that. But in the event that they're trying to, orchestrate another 2008, be mindful that we could see all of these commodities as well as, certain assets as well as stocks collapse a little bit. And again, a lot of people are expecting that, so maybe they'll give everybody exactly what they're anticipating. Let's get you guys now over to BTC/US dollar and see what occurred there for today. So I'm just going to show you guys an overview here as far as what the metals did. What the cryptos did for today. Basically, pull back significantly. I think that cryptos kind of bought what Jerome Powell was talking about and what the Fed was talking about overall. Although they were ambiguous in their statement, a lot of people are coming to the realization maybe they aren't as dovish as one would hope, because a lot of people were hoping that they pull back significantly. And it's nice to kind of see a little bit of sell-off. I kind of got in about the $22,000 mark, and then I sold off about the 27, 28 mark. I think it was yesterday, just due to the fact of I knew that they were going to keep that stance, just due to the fact that they wanted to keep the interest rates high, because remember, they don't borrow out this money. The banks borrow out this money, and then you borrow out this money. So that means overall that they could still get their same effect and still inject certain institutions with cash if they wanted to, just like they already do that anyway. I mean, they pretty much do that. They write these report cards for these banks, and then they do what they want. Let's go and check out the market share of all the coins here. See if anything changed. Probably not, but we got 68%, 27% Doge. It's actually very shocking that Doge is as high as it is, because when it first started out, I mean, it was literally nowhere on here. So it's pretty pivotal to see that actually moved up a little bit here. But yeah, guys, all in all, I definitely see I'll give you guys a little bit of possible price prediction. Again, guys, this is for entertainment purposes only. Please do your due diligence or talk to a licensed professional. But basically, guys, I probably think this guy is going to pull back a little bit as well, too. Again, this is more keenly towards psychologically tied to the stock market as well. It is a risk asset, guys. That's how I view it. I have traded it several times, and I do also here and there use it as a medium of exchange. But I do not hold a lot of weight on it overall. This entity is only probably like 14, 15 years old. It's not really that old, this asset. So we have to, and I got to be mindful when I say asset, make sure you put that in air quotes there. But all in all, guys, we will have to take a look and see how it develops. Let's take a look at what drives everything, that dollar index. So we were just coasting over the last trading day, guys, as you guys can see here. Let's get out of that. So it was definitely a crazy day. We definitely just moved along here, and then obviously we had that interest rate decision. A lot of capital. This basically means a lot of capital was on the sidelines, which that's kind of what we expect. We do expect the capital to be on the sidelines. Then obviously we're coming up to the interest rate decision at 1 o'clock here, and then it definitely just fell off the cliff. 1 o'clock Central, 2 o'clock Eastern, but it just fell off the cliff here. And that's pivotal. I mean, a lot of the times, as you can see here, that's what the shoot up with all the other assets. And I do watch the dollar index throughout my day just to see as a kind of a backdrop of what is actually occurring, so that way I can make my informed decisions as well too. And then we kind of got that low at about 1:48 or 2:48 Eastern time, and then obviously we kind of pushed back up here. So I see the dollar index definitely taking a little bit of a ride upwards. We probably will pull back maybe slightly with that Swiss interest rate decision, depending on how hawkish they are. I think they're going to be probably one of the first ones to kind of turn around. But as far as the G7, I mean, we are still having high inflation readings, so maybe their statements will be pretty hawkish, and we'll take a dive for the 102, lower bound 102, maybe 101 area. But I definitely think overall we'll probably be either right here or take a push up to the 104.50 before the week is out, because that's kind of where we started last week before we kind of things deteriorated to where the dollar kind of lost its steam there. So I definitely think we're going to push back up to the 150 area. But we'll see, guys. I always follow it along here. Let's see what stocks did for the day. So let's just go ahead and read this here. Financial conditions are tightening after SVB collapse and could slow the economy. You know, obviously, yeah. I mean, that's what they want, guys. I mean, why do you think they hike interest rates? They want the economy to be slow. They want to get back to, because for them, they don't care if jobs, start shedding off. They care about that price action. That price stability factor. They want to get the credibility of the United States back under control and not have them be 10, 20, 30, 40% or the next Zimbabwe. So let's just check it out here. I'm going to go off the latest news. Yellen comments rattles the markets, not the Fed rate hike, Kramer says. All right, that's cool. And then we'll scroll down here, guys. I want to take a look at the bonds here. Let's see what was expressed after the readings. The central bank. So basically got the 1 month 4.0 will go out on the 6th, 4.8, 4.5. So we're still inverted, guys, substantially, but we probably are going to see it flatten out a little bit more. And definitely the bonds definitely sold off today, guys. They sold off huge. They sold off initially huge, and then obviously they might come back with that stronger dollar. So I mean that does have a positive correlation with the dollar index. We start to see that rise, we still start to see those yields rise as well too. And pretty much what had happened, guys, is this was a liquidity crisis, just like it always is. Whenever money starts drying up or money starts to get too expensive, people stop borrowing it, whether that's banks or institutions or consumers or businesses. So, and overall that just leads to a deflationary environment. So regardless, however it shapes out, it will still be the same outcome, guys. I don't think anything will be different this time. I think the same economical rules will apply. The financial rules will still apply. And if we tighten too much, just like you tighten anything, we'll choke it off. And basically, we will be deflationary. If they loosen up, we'll be going for a ride with a weaker U.S. dollar. So that's pretty much what it means, guys. Let's go ahead and check out the stocks here for the day. Pre-market looks to be a little bit upward there, a little elevated, but overall that last couple hours of trading session definitely just took a dive there, guys. I think it started to become morbidly clear that they will probably hold rates, because that's another thing too. They can probably, they've effectively already started QE. I mean, they did up 300 billion last week. Will they shore up certain institutions? Yes, guys, they will shore them up. And this is another thing too. We got that VIX coming back down to that 20 mark. That's what we love, guys, because then price action is more predictable, like I've always told you guys. So basically, we want to see that VIX under that 20, because that means we are pretty much good to go, guys. So, and we're getting closer to that. So that means they must be getting a handle on some things. Whenever you see that volatility past that 20 mark, it's a little bit too volatile. Price action is too much. We'll probably start to see sideways trading. And remember, nobody makes any money in sideways trading. Most people have to see a clear trend line in order for them to profit, whether that's options, stocks, bonds, commodities, contract for differences, whatever it is. We need to see a steady trend line. Let's go over to the unusual options activity for today, and I want to talk about a few things there. So I just want to kind of point this out, guys. Tesla was kind of downward a little bit here, but we'll go from the volume for the day. And then, they basically struggle. A lot of people were trying to pile into these 200 and 205 on the expiration for the week calls. But you can see that delta is just not quite high enough, guys. We want to see that delta at least at the spot 40 level. But where the delta was at the spot 40, but a little bit negative, obviously, the other way was the put. So a lot of people were piling into that. And that was kind of pivotal there. Now, I will tell you, it definitely sold off, and I'll tell you when. At about 2 o'clock, it sold off after everybody digested that for the Tesla. And that's one of my most traded options traded instruments there, because it is easier to predict the price action just due to the volatility as well as the volume. You always want volume because that is expressed in liquidity. So we definitely would love to see that. We'll scroll down here. We also had a big contender, Apple there. Apple, let me take a look at that. Definitely moved up a little bit, but then it moved up earlier morning and then it just sold off, guys. So the tech sector definitely took a heavy hit, which was expressed obviously in the Nasdaq being down at 1.5%. So all in all, guys, be mindful, keep some capital to the side, keep your powder dry. Make sure you're getting in and out of these markets. You want to be the guy getting out before the music stops. Let's get over to the Fed tool. I want to show you guys a few things there. So basically, we did have a pretty high probability that we would go up that 25 basis point. Now for the May 3rd meeting here, we definitely are pushing up 50-50 going up to the, and again, I don't quite buy this. I wish it was over to 60%, but I mean, they probably still might move up albeit market conditions of what's happening. Because even I think at this point, if they don't continue to raise interest rates, that will be viewed as a very dovish stance, and then they'll get the counteractive stance of what they want. So if they want it, guys, maybe they will push it. But I am extremely sure. I am mentally sure that they're not going to go past a 5.25. If they do, I'll be pleasantly shocked, because obviously that would be what they should be doing. They should be actually meeting inflation where the target is. So they should be actually getting more towards, I guess, their number 6% as far as the terminal rate. But we'll see how those develop. And then we come out to that June meeting basically at pretty much even, guys. I mean, I look at it basically where it's at from a next rate hike, or where it's at, kind of staying where it's at, and then we go to the July, and we're just all over the place. So I'm going to focus basically on the next May meeting, 50-50 shot. We go up to 25 basis points, and that's huge, guys, because that will tell you everything you need to know. I mean, a lot of time can elapse here. That's essentially over a month. And what does that mean for your portfolio? What does that mean for your 401k? What does that mean for your assets? What does that mean for your cash? What does that mean for the trades that you guys are in? Remember the 4 pillars of the trade. And all in all, guys, I appreciate you guys joining me today. Please like, comment, share, subscribe. Hope I'm giving you guys a lot for the 26 minutes here. And as always, guys, in order to be profitable, one must have the knowledge and insight about the next trader position to stay ahead of the curve. I appreciate you guys. Please like, comment, share. Head on over to my Patreon. I will probably be doing some posting maybe later this week. And I will talk to you guys really soon. Happy trading.